Tonight, I just want to go over classical sampling. I know I gave you guys the last the two problems, and some of you have already turned it in. But here's the so classical sampling. I just want to show problem page 4 and 5. You guys probably already have it done. And then we're going to start in on a new handout, evidence, and another new handout, monetary unit sampling. Let me go back to this one. I thought I had this queued up. Obviously, I don't. All right, so this is what you should have gotten for this is problem 4. And if you haven't done it yet, you can just put, take a snapshot of it and oops, let's try it. Let's try the third. We'll just keep trying this until they get it all on the screen. Well, here, you guys, you can't get the total amount. You should be able to do the rest of it. So anyway, these are the mean per unit. These are all overstated. $600,000, 100,000, 636,000, and 63,000 is the overstatement. And last but not least, the difference estimation be 640,000, and it's a $60,000 overstatement. These are all overstatements because their book value is the 700,000. So you're comparing all of these, the projected values to those, except for this one down here. This one you get the projected misstatement first. So that's problem 4. And you can take a screenshot of that if you need to. And then 5. Problem 5 is like that. I don't know why problem 5 is so much shorter than problem 4. But by the way, the problem 4 and problem 5, those are more the way you're going to see it on the CPA exam. They usually are fairly well condensed down like that. And they may ask you for a to do the whole problem thing, or they may even just have it in a multiple choice thing, and they'll say, using difference estimation, what's the projected mistake? They might be more specific like that, as long as you can do them. And again, I'd kind of like, it's a good idea to just kind of think about what they actually are rather than trying to memorize it. Mean per unit, average, take the average of the audit. Ratio means it's a ratio, and differences means they subtract it. Any question on those? I got a question. I did something wrong here.
Is the third one really overstated?
It does not. That's what I did wrong. I just realized. No, it is. These are all understated. The projected value is more than what they have on their books. So accounts receivable, they have on books at 6 million, and these are all understated. A question you may ask yourself is, accounts receivable are assets. Those are good things. Why do they understate them? They may be understating them so they pay less taxes. The normal Down here. How do you put accounts receivable on the books? Asset going up, I'm just gonna make up a number here, say that he's finding they're off 300,000. And the other side of that is revenue. So this is the usual journal entry for those accounts receivable. Now, you say, okay, well, why in the world do they want to not put that on the books? It's good stuff, the assets, and it's good stuff for revenue. Well, they may not want to pay taxes. And the two taxes they would pay would not only be income taxes, but also sales taxes. So it is possible, usually not for publicly traded companies, but sometimes you have smaller businesses that will, they're just trying not to pay taxes. All right, let's go to the chapter 5. Okay, chapter 5, evidence. I'm gonna combine chapter 5 and chapter 6. They kind of go together. Chapter 5 is on evidence, and chapter 6 is on planning the audit, which means you plan how you plan on getting the evidence that you need to arrive at a conclusion. So I'm going to go ahead and combine those two, and quite honestly, they were kind of combined anyways, because the chapter 6 exam actually has a lot about evidence in it, because that's you're planning on getting evidence. So anyway, the chapter 5 and chapter 6 will be teamed up together. I put them in 2 separate handouts. I thought about putting them in one, but sometimes you get these handouts like too long. And the chapter 6 handout is already kind of long. Okay. I think I left off something here that I shouldn't have. I think I have it in the chapter 6 handout, but I'm going to put it here also. Not a bad idea to have it twice. Audit evidence. Is anything that corroborates or refutes relevant assertion. I'll talk about that in a second. So audit evidence is anything that corroborates or refutes a relevant assertion. In other words, I should say must. So it must either support the client's financial statements or discredit the client's financial statements. Now, if it doesn't do either one of those, it's not evidence. If it doesn't corroborate or refute, or support or discredit the fact, it's not evidence. So it must have some value as far as the validity of the financial statements. Okay. And we're going to talk about risks here. I think we may have talked about this already. I can't remember, to be honest with you. There are three main risks that we deal with in auditing. And they lead to a fourth kind of a outcome. Inherent risk. Oops, wrong line. Let's try that again. Inherent risk is the risk the material in this statement will occur. Now, routine transactions generally have fairly low inherent risk. Everybody knows how to make the journal entry for, buying inventory or making a sale or something like that. Routine transactions have a low inherent risk. These other ones have a little bit more. Non-routine transactions. So you get something that's unusual, that is not along the same lines as your normal business, and those are going to have a higher risk. So things that are routine, low risk; things that are non-routine, higher risk. Estimation transactions. These a lot of times will have judgment. So client judgment a lot of times will make these have a higher inherent risk. Complex transactions obviously have a higher inherent risk, and it's actually higher for two reasons. One, for errors, and two, for fraud. A lot of times, if there is a fraud, they will try to hide it in very complex transactions. And so when you run into complex transactions, it should be a red flag that you got to figure them out. You cannot simply take their word for it. So complex transactions are often, oh, look how blurry I am. I'm not usually that blurry. Let me do something here. Oh, I know. I think if I turn this off and turn it back on. Hey, look at that. I cleared up. A lot of times complex transactions, when they do a fraud, they don't say, fraud expense and cash I stole. I mean, you never see that. So a lot of times when things are, when there are things that they'll put them into very complex transactions. And sometimes needlessly, especially if it's needlessly complex, they'll have all kinds of ins and outs and all that kind of stuff. You have to sort through those. Also, a lot of times, excuse me, things that are, for instance, if they have a whole bunch of addendums and those sorts of things. I remember, when I was in internal auditing, we were actually looking for problems. We weren't looking to see if the financial statements were necessarily fairly presented. We were looking to see where the problems were. And I would open up the files, like for contracts and things like that. And I would look for the ones that had all kinds of stuff scribbled on them and things, because those are the ones that are going to have problems. And almost 100% of the time, when you found the ones that were like that, that was where you found the problems. So a lot of times things that are very complex and things that are somewhat disorganized, those are things you need to figure out. And quite honestly, the people who would do stuff like that are people who figure that you won't bother to figure it out. They can give you some story or something. Okay, so inherent risk is a risk that material misstatement will occur. When fraud is involved, this is 100%. In other words, it's 100% sure that material misstatement will occur. Which is one of the reasons why it's hard to do these. When someone is actually committing a fraud, it's something that can be difficult. Now, with all risks, well, let me ask you, what do you think about risk as an auditor? Do you want all your risks to be high or all your risks to be low?
Low.
Oh, right. So you always want risk to be low. So that's kind of the general rule when we're looking at risk, that you want them to be low as possible. So you want inherent risk to be low. You want it to be a low risk that a material misstatement will occur. Control risk. Control risk is the risk that the client's controls will fail to identify a material misstatement. So in other words, let me make that. So you want this to be low. Hopefully that they will catch material misstatements if they do occur. So if material misstatement occurs, then you'll catch it. That's the what you want to see. And a lot of times, if it's not fraud, they will. So inherent risk is a risk that a material misstatement will occur. Control risk is that the client's controls will fail to identify it. For example, let's say that they purchase a stapler for $6. Okay, so it's a $6 stapler, and I'm entering it, and I enter it as a $6 million stapler for some reason. I'm not paying attention, and I enter it as a $6 million stapler, which is material. Hopefully, the system will catch it. Could be the computer system says, whoa, 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 there is no item for $6 million in our system. It could be that it hits somebody's budget. Well, why did my budget just get hit for $6 million? The budget's only 60,000 anyways. Why is it? You'd hope that that client's controls will catch it, and they should have their controls set up so that they will catch anything. Those material misstatement. So you hope that they would catch it. That they wouldn't fail. You want that risk to be low. Okay, it's a low risk that they're not going to be able to catch it. All right. And detection risk. Pretty much the risk that the auditors will fail to detect the material misstatement. So these kind of are linked together. Inherent risk material misstatement will occur. You hope the controls catch it. If the controls don't catch it, the last hope is that the auditors will catch it. Detection risk is a risk that we, the auditors, will fail to detect a material misstatement. Audit risk. So if everything fails, there's a risk that an undetected material misstatement oh. Will appear on the financial statements. Audit risk is a risk that an undetected material misstatement will appear on the financial statements. So this is an audit failure. And of course, you obviously want this to be low. So undetected. If you detect it, then it's fine. But if you don't detect it, that's bad. Okay, so let's kind of go through and see what we have control over here. Okay. Now, I'm going to remove this for a second. Inherent risk. The auditors only assess this risk. We cannot change it. And same thing for control risk. Auditors only assess this risk. They cannot change. This one, we can. I'm gonna leave it at that. So this is the only one that auditors have control over, is the detection risk. We can control the detection risk. We can't control any of the other stuff. Hey, what am I doing here? I don't know. That might look weird. Anyway, auditors only have control. So we only assess the inherent risk. We assess the control risk. We can't change it. Those are, well, first of all, those are controlled by the client. Second of all, the time has already passed. For instance, if they had bad controls, let's say, in June of this year, you can't jump in the time machine, go back to June of 2022 and change those controls. So if the controls were bad at that time, you as an auditor, you can increase your testing during that time period or whatever it was, but you can't change it. So you might change your assessment based on your evidence, but you're only changing the assessment. You're not changing the actual, the actual inherent risk, the actual control risk, those are set. Whatever they are, you may, like they say, you assess them and you may change your assessment based on information, but you cannot change the actual inherent risk or control risk. You can change the detection risk. You can say, okay, this is, instead of auditing at the 95% level, we'll audit at the 99% level. We'll increase our auditing because they may have had a problem in June, So you can change the detection risk, but you cannot change the inherent or the control risk. A lot of times you'll see CPA questions and they'll say, increase the control risk or decrease the control risk or something like that. You only assess it. You cannot actually increase or decrease. The only thing you can increase or decrease is the detection risk. Okay. Is this on the same page or not? All right. Not sure if these are all going to fit. Probably not. All right. I'm going to check something. I want to see what this handout looked like before I started hacking it up. Oh, those are on the next page. See that? Okay, we'll put them on the next page. I'm sorry. Okay, all right, I'm back. There actually is a mathematical formula for audit risk. And you'll see this, it has shown up at least a few times on the CPA exam. And basically the inherent risk times the control risk times the detection risk equals the audit risk. All right, so let's see how this works. So for this first one here, inherent risk is 40%. Probably a little bit high, but the control risk is 30%. Detection risk is 20%. And that should equal the audit risk, whatever that is. So 40% times 30% times 20%. Equals 0.024. Oops. Or 2.4%. So it's kind of a mathematical formula. I don't know if any CPA firms actually do this, but I think they could. And it's a good way to think about it. You know, it's one way, it's kind of a theoretical way, I think, more than a mathematical way almost of thinking about it, that they all, you know, they're interacting. Okay. They've also done this. They'll tell you what the audit risk you want it to be. So in this case, you want to audit to stay the 95% level. You have inherent risk of 50% and control risk of 40%. What do you need the detection risk to be?
Is it 20?
I asked a question I don't know the answer to. It could be.
25%.
All right, let's see. So 0.4 times 0.5. I think it's, yeah, 0.25, I think it is, right? Yeah, so basically, like so it'd be 0.5 times 0.4 times, I'm gonna put this as detection risk equals 0.05. Multiplying those out would be what? 4, was that 20? So you kind of look like this. The 0.5 times 0.4 would be, I'll put them together. So the detection risk would be, those are the, so 0.2 times detection risk. So if you divide by 0.2, it comes out to what you said. I think it comes out to 0.25. Right? Yeah. Yeah, so and then they have had those on the CPA exam. At least one of those has been. Okay, another one that I've seen less often, but I have seen is risk of material misstatement, and that is the risk of material misstatement is just the inherent risk and control risk. So you're just multiplying those two, rather than it doesn't have anything to do with the trying to blank here, the detection risk. What, 0.12? So the risk of a material misstatement will occur is the combination of those two. Again, I'm not sure how many CPA firms actually do that, but it's a good way to think about it, though. You know, and And if you look at these numbers, like for instance, this first one, inherent risk 40%, that's huge. Control risk 30%, that's huge. You can still get it fairly low, even with pretty high risks all along the way, actually. And this is one of the reasons why we do testing and things like that. You can actually get fairly confident, taking much smaller samples than say 100%. Even if you can't take 100% of the sample, there's no reason to. You can get it down very low, and in fact, sometimes you see that they have to be far less than 1% or whatever. Amount of risk that they have at the end for the audit risk. And again, you can do that a lot of times with a taking a fraction of items to test. Okay. So let me see here. And I'm gonna try to save some space here. Okay. You're required as an auditor to get sufficient appropriate evidence. And the question may be, well, sufficient appropriate for what? Sufficient appropriate evidence to support an opinion. All right. What does sufficient mean? You say you get a sufficient amount of evidence. What does that mean?
Proof?
Yeah, it is. It is definitely a proof. Sufficient usually is for a quantity to get enough evidence. So enough for a quantity, and appropriate. Maybe this is enough good evidence to support an opinion. We're not saying it has to be the best evidence. We're not saying it has to be, 100% or anything like that. We just say you have to have enough good evidence to support your opinion. So sufficient appropriate is really enough. Sufficient is really a quantitative, an amount, and appropriate is a qualitative. I should probably put that on there. Oops, wrong. Run out of space here. So enough is a quantitative and good is a qualitative. That's you'll see that sometimes. So they got to get enough good evidence. They have to get a quantity of quality evidence to support an opinion. And if they can't, then they can't make an opinion. Okay. Documentary evidence, documents, and we have rankings for those. And the rankings are dictated by who created it and who is holding it. And the best is when we have it created by I'll make it green, third party and held by a third party. And we'll talk about what some of these are. Okay. The next best, or less worse, or how you want to put it, is created by a third party and held by the client. And the worst evidence is created by the client and held by the client. So a third party would be something like a bank. Let's say that you had a bank send out a bank statement. Now they might send it to the client. That would be medium evidence. If the bank sent the bank statement directly to the auditors, it would be the best evidence. The client never got a hold of it. And by the way, why do you think there is a difference here between the third party, created by a third party, one never goes to the client, and the second one, not as good, goes to the client? Why is going to the client such a bad thing?
The client may change it.
Exactly. The client could audit it, could alter it. So if it never goes into their hands, they can't alter it. And the worst evidence is client made up, client holds it. Okay, so let's look at some of these different types of evidence here, and we'll kind of go over each of those. All right, customer purchase order. So a customer sends a purchase order to the client, one of their customers, the client's customer. So for instance, a customer of, say, IBM sends them a purchase order. What would the rank of that evidence be? Would it be the best, medium, or worst?
The customer sends a purchase order directly to the auditors, or
No. To the client.
medium?
Good. Yeah, you're right. Yeah. Now we'll talk. Oops, that's the wrong color. We will talk about that, though, that it is possible to get some of these other things, and later on we'll talk. Okay, sales order. Now this is one that the client makes up. So client shows you a sales order. They make their own, you go to IBM, they have their sales order, and the sales order will have,
Worse.
yeah, worse. They made it, they hold it. Pick list or packing list.
Worse.
Worse. Client made it, client holds it. Sales invoice.
Worse.
Worse. Bill of lading and proof of delivery are two shipping documents. And
Medium.
Yeah, these would probably both be medium. It's possible to get these moved up to oops, what am I doing here? It's possible to get these moved up to best if you contact the shippers and ask them to send the two documents. And it's kind of a wrong order here, but we'll talk about down here what the bill of lading is and what the proof of delivery. So it is possible, though, that this down here, if you contact the shippers, that you could have them resend it to you. I guess you do probably the same thing with the purchase order, although maybe a little bit odd to have that happen. But certainly the shipping documents you could get. So you notice that some of these things here that they might give you as evidence if they make it themselves, it's yeah, it's not as good. All right, now bill of lading, proof of delivery. These are two kind of important ones, and the most important one is this bill of lading. Bill of lading. So what happens is, and I'll tell you why this is really important in a second. But what happens is when something gets sold and gets shipped, whoever picks it up, there is a legal document called a bill of lading. And a bill of lading gives somebody possession of the items, but does not give them title to the items. You know, the shipping company doesn't own the goods. They'll never own the goods. So you're simply taking your items and putting in the possession of somebody else, the shipping company, and then it'll go to whoever is buying it or whatever. Now, it's a legal document, and the bill of lading is very important because it has a third party involved. Both the shipper, the client, and the freight company or whoever's picking it up, they both have to sign it. It's basically an agreement saying this is what was put on board. So it transfers possession of the goods. It does not transfer title of the goods, but possession of the goods to the transportation firm. Everybody must agree on the goods, what they were, signed by both parties. Has the seller and buyer addresses on them. Prices are usually not included. There's no reason to. You're not selling it to, there's no agreement on the price between the shipper and the seller. So there is no, you say, well, why don't they just put the prices on there? That's not part of the agreement. There's no way the shipper knows what the value of those things are, and probably doesn't even care. At least, maybe for insurance purposes or something, but generally speaking, they don't agree on a price. That's between the buyer and the seller. The shipper does not agree on the price. So it basically is saying, here's our stuff, you're in possession of it, you don't own it, and here's who to take it to. All right, so bill of lading is between the shipping company and the client. Now, oftentimes you can get those bill of ladings to, you can get them directly from the shipping company. Right, now, here's the important thing about the bill of lading. It is proof that something has been shipped because you have this third party involved. And oftentimes you can get those, if you want to, if you need to, you get those bill of ladings from that third party. But it's evidence that there was something shipped. And it'll have a list of things that are, that were shipped. So it's very important because that's going to determine your sales. There's going to be a cutoff for sales, which impacts your income. It's also going to be for your inventory. What inventory isn't there? And inventory is usually a very large account, and it's a very active account. So it'll give you a good cutoff as far as what was actually sold on that date, and what was the inventory was, what was left on that date. So the bill of lading is very good. Now you might say, well, what about the proof of delivery? We want to make sure it's delivered. The bill of lading shows evidence that it was shipped. Now, something may have happened in shipping, maybe the truck caught fire or whatever it was, but the client, when they booked that thing, they actually did make the effort to make the sale. And so there certainly isn't any fraud involved if there is a bill of lading that shows that something was put on the truck. It shows that that those were, at least at the time, valid sales. So the bill of lading is actually more important than the proof of delivery. Now, the proof of delivery might come up later if they have a, if they have a customer, say the client, say IBM has a customer that says, I never got it. Yeah, then you look at a proof of delivery to see if they did. However, the bill of lading is probably the most important shipping document, and because it is a third party and you can actually get those from the third party, it's a very important one for auditors. It's, I don't always know because it's the most important, but it's right up there. Proof of delivery is another one though. This is especially to see if the accounts receivable is valid. It may valid is a bad term. Collectible. You know, if it ever arrived there, it's probably not collectible. Okay, I am going to stop here because now it's going to get into something completely different. Okay, so let's stop here and we'll be back at, say, what is it? 6:52, let's say 7:02. Oops. Try it again. And then we're gonna start looking at the monetary unit sampling. Any questions? Okay. Okay, hey, that's not key. Monetary unit sampling. Monetary unit sampling is a sampling that is done only for auditing. And because of that, in the past, people like myself used to think that it was the best, the best way of doing sampling because it was made specifically for auditing. That's really not the case. There are some situations where it's superior, and there's some situations where it's not very good as compared to classical sampling. Classical sampling can be used for anything. Classical sampling can be used for anything. You can, if you wanted to see how much corn was in a cornfield, you could go take a sample of the corn stalks, see how much corn is on each corn stalk, and use a mean per unit or something like that to get an estimate. Okay, there's this many corn stalks in the field on average. They have this. You can use that for anything. Whereas monetary unit sampling can only be used for auditing. And there are some things it does very, very well. And this is why it's used. And there's some things that it doesn't do very good at all. In fact, it's terrible. But anyway, here's the idea. So this is the client has their accounts receivable. And here's the book value of each item. And this cumulative total is simply the running total of each of these. So for instance, the first one is 500 and 500. These are just, that. The second one is adding them both up. So 500 plus the second one, 200 equal. Wrong thing. Try that again. So it's just a running total, and then 600, 700 plus 600. So this is just a cumulative total. So the total amount that they have for their accounts receivable is 5,000. And we're going to pick a sample size of 5. All right, now I want to kind of show you what the whole idea behind this thing is. It's actually fairly ingenious. What we're going to do get rid of those. I think I can. Kind of. All right, well, it's better. What we do is we'll take that $5,000 accounts receivable. And we're going to split it up into 5 different chunks, basically, of $1,000 each. So this $5,000 is going to be split up into $1,000 chunks, 5 of them. We have 5 items. And for each of these, we're going to pick one item to represent this entire interval. So every one of these will have one item that will be responsible basically for this entire interval. By the way, these are called intervals. I guess I don't need to write all this. I'll finish it off. So we broke it off into these 5 chunks that we call intervals of $1,000 each. And we're going to pick one item from that and assume that that represents the entire sample of 1,000 in this interval. Pick another item and have it represent that entire 1,000 in the interval. So we're going to keep doing that for all 5 of these. Okay. Let's go back to problem. Okay, so find the sampling interval. Oh, we kind of already did. So this is so accounts receivable is $5,000. Get a little room in here. And we're going to divide it by 5 items. Oops. And so that's going to be all right. Now here is the great part of it. So select the sample from the cumulative book total column. Okay, so this is the cumulative book total. Or value, I should say. All right. So here's what we're going to do. We are going to pick the item, the first item that goes past that cumulative $1,000 interval. So the first one that goes past that first 1,000, that's the one we're going to pick. So which item over here goes past the $1,000 mark in the cumulative column?
3.
Item 3.
Very good. So item 3 will be our first one that we pick. It's the one that goes past. I'm going to highlight this thing. Okay, which one takes us past the $2,000 mark?
6.
Yep. 3,000?
7.
Just wait a minute. Okay. Hold on. 4.
9.
And then 5,000 would be 10. Excuse me. Okay, so these are the items we're going to have. We're going to have item 3, 6, 7, 9, and 10. Oh, you know what I could do? It's just from here, I guess. Okay, so this is terrible. Okay, so this is item 3, 6. Okay. Now you'll recognize this is it's sort of like the ratio estimation thing we did before, audit divided by book. We're going to do the same thing for these. So let's look at number 3. Number 3, the book, the audit value was 600 and the book value was 600. Okay, so those are the same, so that shouldn't be too much of a problem. So 600 divided by 600 is just 1. The interval is 1,000. So we're gonna say, okay, that one item is going to represent that entire interval of 1,000. The projected value of that, well, this is, you know, all correct, basically. So the projected value is going to be the total 1,000. And the projected misstatement is going to be 0. So that one item, you know, it's okay. So this entire interval is okay. And the projected misstatement for that first interval is 0. Okay, let's go to number, what is it, 6? Number 6. The audit amount is 560. And the book value is 800. Okay, so those are not the same. The interval is still 1,000. You know, actually, all the intervals are going to be the same here. Still also in the 1,000 for each one. Okay, so 560 divided by 800, whatever that is, times 1,000. 700. Check that. Okay, so we're saying that that interval, we picked this one item. I should write these in. Hold on. So this is audit, and this is the book amount. Oops. Okay, so if this interval we say is worth 700, then what is the projected misstatement for that interval?
300, 300.
300, good. Oops, should be $1. Yeah, so this $1,000, we're saying this $1,000 is really only worth 700. So the misstatement is 300. All right, so we go to 7, 450 and 450. If I'd been smart, I would have made those different colors. All right, so this is still 1,000. 450 or 450 is just 1, so this is no problem with this one. Okay, number 9. 300 over 750. Is 400. And so the projected misstatement is what? For number 9. For
600.
and the last one. 900 over 900, no problems there. So that'll just be Okay. Now, if we add all of them up, all the intervals added up together will be the 5,000. The projected value is
4,100.
yeah. And 900. So the projected misstatement up here would be 900. So this is basically how we do this monetary unit sampling method. Now, there are some things about this that are not very obvious, but are a big help to it. One of the things, the really ingenious things about this method is how that it actually picks the sample for us. Notice we didn't pull out a random number chart or table or anything like that to get the, to pick the sample. The sample, this method actually picks the sample for us. Whichever item crosses the cumulative total, that's the item we pick. And it's maybe one of the most important things about this one. Hey, that's not me. That's my scratchings. You'll notice when we did the classical sampling, we didn't pick a sample size. And we didn't pick a sample size for a reason. It's pretty involved, it's pretty complex. It's never been tested, to my knowledge, at least on the CPA exam. They've had questions about it, that if the variability increases or something, what happens with sample size, but they've never actually said, here, classical sampling, figure out the sample size, because it's pretty involved. And the biggest thing that's involved in it is you have to get a standard deviation. Now, notice you haven't picked your sample yet. So you have to do a pre-sample, possibly, to get a standard deviation for the thing. So classical sampling, they don't have you find the sample size. And it's not, in this class, it's not worth it to take an hour out of class to figure out how to do that. Now, for monetary unit sampling, it's very important that it picks the sample for us. Notice that it picks the item that crosses the $1,000 interval, right? Whatever item crosses that $1,000 interval for the one we just did. So let me change canvas here. Notice that if you have an item that is over $1,000, it's guaranteed it's going to be picked. So if the item is over $1,000, it's guaranteed to be picked. It may be picked twice. It may go through both of these. If it's $1,200, it could pass this one and this one. So the larger the item is, the more likely it's going to be picked. Now, here's the great thing for this method when it comes to things like fraud. When it comes to things like fraud, if the item is bigger than $1,000, it's guaranteed to be picked. So if someone's cooking the books, they're trying to make themselves look better, they're trying to make their sales higher. The more that they increase that, the more likely it's going to get picked. And at some point, it's guaranteed to get picked. If it goes higher than the interval, it's guaranteed to be picked. And even if they spread it out over many items, each one of those items has a greater chance of being picked. The more they cook the books, the more likely it is they're going to get caught. So that's the beauty of this method, that if they're trying to overstate an account, it's more likely to get caught. Now, this method, it's great when they're trying to overstate items. It's terrible at understatements. In fact, it's so terrible that if they do find an understatement, we ignore it. It's not supposed to catch those. So, you know, it's not used for everything. But things that are likely to be overstated, things like assets, things like revenues, those things are, it's good to test using this monetary unit sample. Another thing that's not obvious about this method is that sometimes they call it, you know, dollar unit sampling or something like that. Monetary unit just means it could be used in any currency. But they basically count each dollar as an item. So you say, well, okay, how come they don't have to, you know, classical sampling, you know, has been around for a million years, and you know, we know that you have to get a standard deviation before you start, you know, figuring out a sample size. Why don't you have to do it for this one? It's sampling, well, you know, and basically everything folds into the normal distribution and all that. Why don't you have to do that? Because each item is considered one unit. So each dollar is one unit. Everything has a value of 1. So what's the deviation if everything has a value of 1? 0. They're all ones. There's no, you know, the average is 1. The standard deviation is 0. They're all ones. So it's kind of a weird method in that sense, and how it's kind of put together. But picking the sample is a huge benefit of it, and because it'll likely pick things that are overstated. The more overstated it is, the more likely they'll get picked. It's not very good on understatements. If you understate an account, it's less likely to get picked. This is not a good method to use. Okay. All right. Well, the next thing we're going to look at is this. How do we pick a sample size? If I can get my mouse to, you know, we came up with 5 items here. How do you find that? And that's what we're going to do in the next page. And we got this formula. So it's not as easy as I made it out to be, but it's monetary unit sampling, sample size, and interval calculations. So there's a few accounts that we have here. Oops. And here's the formula. We have book value times reliability factor divided by the total misstatement minus, there's a minus here. So this one is times, this is minus. Let's take the time. I don't know why I didn't make those bigger. I don't know. All right. So let's take the thing we have here. Okay, so the first one is the total book value. So here's the population book value. Tolerable misstatement. Oops. Oops. How come that's not centered? And the expected misstatement. Now, 2 things we need to get to finish out our thing here. Reliability factor at 0 and the expansion factor. Obvious question now is, what are those? And those are down here. So down here we have reliability factor. We'll do that one first. And row 0 is used for the reliability factor for sample size. Actually, it says that up here too. Okay, so here we're at the reliability factor at 0. Risk of incorrect acceptance is 5%. So we're looking at a factor of 3. Just so I don't goof up, I'm going to copy that. Okay. And now we need the expansion factor. So we go back down here. Expansion factor is a little bit easier in that there's only one expansion factor for each percentage. And in this case, it's 1.6. So we need this table, basically. Okay, now don't forget that this is a minus. I don't know why I didn't make that bigger. Oh, kind of messed up the. Okay, so we're gonna take 1,600,000 times 3. $1,800,000. $120,000 divided by, scratch that. Bad marking. 120,000 minus 5,000 times 1.6. I would do this first. 5,000 times 1.6. 5,000 times, times 1.6.
8,000.
8,000, okay. So 120 minus 8 is what you said, 112?
Yep. Yeah, so this comes out to be 8,000 under here. Five times 1.6, so 120,000 minus. Oh, don't do that, Mark. I think speaking to myself in the third term, third person. Okay, so 4.8 million divided by 112,000. $42.85. Now we can't take 0.85 of an item, so we'll round it to the nearest one. So our sample size is going to be 43.
So we're gonna take 43 items out of these 1.6 million. We're gonna take 43. And that's all we're gonna use for the to get our total. By the way, notice that we don't even know how many items are in the sample. You know, that's another beauty about this thing. You don't have to worry about, oh, it's this many items, and you know, this is how do you pick them and all this kind of stuff. None of that. But we do define the interval, and the interval is, well, okay, if we have 1.6 million is our population value, and our sample size is 43, then what's our interval? And I'm gonna round off the nearest dollar. Oops. Oh. 37,209, something like that. 37,209, 30 cents, something like that. I'm just gonna leave it at this. So that would be our interval. So we're gonna take 43 items. The first one we're gonna pick is at 37.29. The second one's gonna be at whatever, 74,418 or whatever it is. So every item that goes, you know, and again, we don't even know how many items are in here. It doesn't say how many items. But we're gonna pick the ones that cross these intervals of 37,209. And any item that's bigger than 37,209 is guaranteed to be picked. Any question on that?
Yes, who predefined the risk of incorrect acceptance?
That's a judgment call by the auditors. That's a good question.
Okay, thank you.
Yeah.
And is the tolerable misstatement again judgment call, or based on the size of the company, or the size what is material? Is that?
Yeah, good. That's another excellent question. Especially misstatement. Yeah, this could very well be based on judgment. It can also be it also could be what they had last year. For instance, if this is a recurring audit, it might be, okay, last year we had a $5,000 misstatement. We'd expect the same thing this year. So but it still is a judgment, you know, that you're making a judgment that the last year's one would be the same as this year. So, yeah. And one of the things about sampling, sampling is not, or auditing, you know, people think, oh, sampling, you know, it takes it out of that judgment realm. No. It's a judgment. Are you going to audit this at the 5% level, or the 1% level, or the 10% level? That's a judgment call. What's the expected misstatement? You know what, maybe what it was last year, but maybe there's circumstances this year. Maybe they put in a new accounting system that makes it more risky or whatever. These are all judgment. And auditing, however you do it, we try to quantify it. That's what we're really doing here. We're trying to quantify. But in the end, it's judgment. And that's one of the reasons why it's hard to teach, it's hard to learn. I mean, when I was auditing, I think it was a good couple of years before I really kind of understood exactly what we were doing, you know, because you kind of figure out that it is judgment, you know, and that, okay, you're kind of learning judgment from usually people around you. I had a really good mentor, and I had a couple of really bad people I worked with, but yeah. And so you learn auditing through others, and there's a good and bad to that. You know, the good part is if you have good auditors, then you learn their judgment and all that kind of stuff. If you have auditors that aren't so good, it can be a double-edged sword. But yeah, it's all judgment. And to what level you're going to audit to, that's a judgment. the expected misstatements, those are judgments. So it isn't that we get out of the, we don't do this sampling to get out of making judgments, but what we do is we try to quantify it. Okay, given these, given these judgments, we want to be at the 5% level. What would that look like? Okay, let's do one more. Oops, carried away there. Let's do one more, and then I think we'll call it a night. And yeah, now here we're at the 10% level. Why, again, those are, oops. Back. That's going to be a judgment. Be careful on this one, though, that it is a different the risk of incorrect acceptance is 10% on this one rather than 5. Tolerable misstatement. This is also a judgment. How much are you going to let this account be out of? What's material to this account? Oops. What are they doing here? Oh. Oh, 113.24 or something like that. So, and for this one, you round it off to the nearest whole number, so it'll be 113. So they got 113 items. And that means an interval, I'm gonna run off the nearest dollar. Oops. Um, 22, 1, 2, 4. 22,000. Well, that's gonna be the interval. And again, there's a real beauty to this, and that it's gonna pick the items for us. We don't have to get out a random number table or anything like that. Also, I don't think I mentioned this, not only as if they get an item bigger than the interval, is it going to be picked, but also larger items in general are going to be picked, even if it isn't as big as the interval. But certainly if something is larger than $22,124, it's going to get picked. And the more that management overstates something, the more likely it is to get caught. And if it goes over 22,124, it's 100% certain it'll get caught. Question on that? Okay, let's stop here. And I know this looks a little bit clumsy, with the sample size here. You think, okay, that's kind of a pain, but actually, this is way easier than for classical sample. This took us like even doing it the first time, it takes like 5-10 minutes, but it's way easier than classical sample. It doesn't appear that way now, but. Okay. Question on this? All right. Save that and. All right. Well, that's it. I think you guys have a test to turn in or something, right? Yeah, chapter 3 exam, is it this Friday? Yeah. So chapter 3 exam is this Friday. Any questions on any of that? And again, if you don't get it in, don't worry too much about it, just get it in when you can. It just won't be in your grade to date until you do put it in. Any questions? Off my lights here to make it look like Dracula. Okay, well, I will see you guys in a week's time.
Thank you.
Thank you. Have a good
Thank you, Professor.
Thank you, Professor. Have a good one.
Thank you, Professor. Have a good night.
I will.
Thank you, Professor.